Hey, good morning, everybody. It's Hammer. Today is Tuesday, April 16th, 2024. I, of course, am with Originator Success here at the Daily Mortgage Rate Update, the only place on the web where you get every day at 9:30 a.m. Eastern Time. Talk about what's going on with mortgage rates and pricing, even though today's conversation not going to be a good one, guys. Not going to be a good one. But anyway, we'll talk more about that in a minute. Remember, you can go ahead and watch the replay anytime you want. And if you are watching the replay, don't forget to give us a hashtag replay in the comments. Always appreciate that. If you're on Facebook, don't forget to smash that like button, tag another friend, share us in the group. If you're on YouTube, go ahead and give it a thumbs up, hit that notification bell, subscribe. Remember, you can sign up and get our written email lock advice to your inbox each and every weekday morning, www.ratelockadvice.com. Get that email. If you're signed up and you're not getting it, your lender may be blocking it. We're noticing a lot of lenders blocking CRM emails. What a pain in the ass. Anyway, go ahead and sign up for our text alerts. So those do go through www.ratetextalerts.com. Also, you can sign up and learn more about us at originatorssuccess.com. Like a reminder that I'm going live every day. Check out hmmr.io/reminder, and we can give you that as well. So with that out of the way, let's go ahead and say hi to all the live folks. Who do we got here this morning? Say good morning. At least we got each other, y'all. That's all I can say. It's hindsight's 2020, and man, what a difference, right? So we got Mallory Fodiatis. Good morning, Mallory. Tim Kleilisser, Scott Menser. Good morning, Deb Dickinson, Allison Foy. Great to see you, Mike Morano. Mike said, nice, happy text headline. Yeah, I said it's bad, real bad this morning. Monica Dinkins, good morning. Dan Crowley, sir, great to have you here. Yasmin Martin, Kenny Rivard, great to see you all. James Mahan, Michael Love, some new faces. Don't know you guys, so welcome and thanks for joining me. Is this your first time? If anyone's first time here, let me know in the comments. Always appreciate you. Karen Bratton, another name I don't recognize. So Bobby Searson, good morning. Mike Tebow, great to see you. Those names I do recognize. Long-time fans, long-time listeners, long-time friends watching with me. So, all right, well, let's go ahead and dive in, y'all, and get into it this morning. Mortgage-backed securities, we're watching that 6.0 coupon. We did drop last week. The 5.5 on Monday yesterday, we changed to the 6.0. Shows you how bad things are getting. We are seeing that at 99.07. It's down about 30 basis points in the morning. You could see just a clear continuation of a downtrend. Look at these candlesticks. Normally, when you see this much negative technical reaction, you want to see a bounce, but we have broken through so many technical support levels at this point. The fact that Friday we had a bit of a bounce, and then Monday and Tuesday, we've seen that bounce totally disappear. This is a lot of concern. Attention treasury yield. Let me see if I can zoom in on that. That 10-year treasury yield now 4.67, and it is well on its way up to that 5% mark, which I've not seen since back in October. I'm going to go ahead and put this on a year. I mean, look at this. We saw this up in October when we were up in that 5% mark, and it is marching very clearly here. Again, this is one of those situations where hindsight is 2020. We rolled into the CPI inflation data last week looking for a little bit of help, and instead we got a whole lot of hurt. Very, very strong reversal in reaction to Fed rate cuts. Basically, that is what's leading mortgage rates to go up, and it's what's going to hold mortgage rates higher, and it's stopping any chance of improvement, is the idea that the Fed is not going to need to cut rates, maybe even at all this year. All right. Right now, when we look at Fed futures, we've got the same numbers that we've been looking at all the days here. Let me just get rid of this. Why is that not coming up with my... Okay, well, my little extra window there is broken. So let me do this. Bear with me, guys. Just got to get this lined up here. Let me just pull this a little bit more. All right, here you go. So taking a look here, we're still basically looking at Fed futures pricing in the idea of 1 or 2 rate cuts for the year. Remember that markets at the beginning of this year, just a few months ago, we're looking at 6 rate cuts 1.5 from the 5.25 that we're at right now. Markets now putting in the idea that we will see one cut to 5% or two cuts to 4.75. There is about a 15% expectation that we still see three cuts here. There's even a 12.5% expectation that we won't see any rate cuts this year. Interesting headline here on Bloomberg, and let me go ahead and pop that up for you. What if the Fed rate hikes are actually sparking U.S. economic boom? Whenever I feel like I just don't have a clue on what's going on, I read some of these headlines, and I mean, at least this one does say a radical theory is spreading as the economy defines expectations. But you look at this and you wonder really does for these people. Really does for these people. Why am I? Would I be so offensive? It's simple. Do they not look at the fact that the reality is people have more money, and what they're saying is that, and I'll get back to why I think this is stupid. It's saying that what happens if an idea so radical and mainstream, the economy isn't booming despite higher rates, but because of them, it's the thing that a handful of people curious about the idea, say that the where do they get this? The contrarians argue because the jump in benchmark rates from 0 to 5% is providing Americans with a significant stream of income from their bond investments and savings accounts for the first time in 2 decades. Listen. An interest rate of 4.25% in your savings account, which is what I have on my high yield accounts and my PNC account. I make a few $100s in interest. Is that, and that's having tens of thousands, hundreds of thousands of dollars in savings. How many Americans have hundreds of thousands of dollars in savings? I am not a fan of stocks. I know I'm stupid to have my money in there, but anyway, how many people have hundreds of thousands of dollars in savings accounts and are making a few $100 a month in interest? Call it even $500 a month in interest, and they're out there spending that money. No, you dumbass economists. People are spending money they don't have. They're spending money on credit. We have record credit. We've talked about this many times. So it's just stuff like this that makes me laugh my ass off, that this is even something that's going on there. I did see a Bloomberg article yesterday, though, that did concern me. It was one of the ones that first started talking about the idea that the Fed, UBS strategists even think the Fed hiking rates is a real risk. This is a concern for me. If we see more articles like this, if we see more momentum in this direction, it's going to push mortgage rates up. Remember, I've said it before, rates have a bit of a cap, but the cap is not applied anywhere near the way that I would think it would have by now. I would have figured we would have seen that 10-year at about 4.5. We're already up to 4 point. We're almost 4.7 on the 10-year yield. That is a huge jump. Looking at mortgage bonds and mortgage-backed securities, let me make this full screen so you guys can see this a little bit clearer. Let me get my head out of the way. All right, taking a look here. Again, let's put this up for 6 months. Look at how much further we are. We're hundreds of basis points. This was down to about 97. 96.09 as the lowest point for the day. That's 300 basis points lower than where we're at right now. All right. So arguably, we should not see the worst rates we saw near October unless mortgage-backed securities were to continue to go all the way down. The 10-year crested around 5%, though. Not nearly as big of a difference, but still about 30-something basis points higher than where it is today. However, if we start seeing more and more talk like this, then that's going to be a concern if we see more talk like this. Now, today, Fed Chair Jerome Powell speaking for what is probably his last time before the Fed meeting on May 1st. He's going to say a lot of the same things, and I'm looking at your comments. Mike said the float boat is dry docked, so it doesn't sink like MBS pricing. Yeah, it hit that one on the head. Ron said, good morning. Not sure if we should celebrate National Wear Your Pajamas to Work Day or National Eggs Benedict Day. I like Wear Your Pajamas to Work Day. I am not wearing my pajamas to work today. These are shorts and, of course, an Originator Success shirt. However, I do fully condone the idea of wearing your pajamas to work day. Yeah, I mean, it is a brutal. Mike said the float boat is docked, so it doesn't sink like MBS pricing. Again, hindsight's 2020. I wish I had told everybody to lock their stuff up a while back before the CPI data, right? I mean, I warned that we could see some things, but I didn't think we'd see this kind of pivot with the idea that we've given up. Let me throw this on the side of the screen here. We have given up the idea of any kind of rate cut in June, an 80% expectation that rates will remain the same in June. July, only a 55% expectation. That's only, right, that we'll see rates remain the same in July. Remember, they were looking for a March rate cut. By the time we get to September, that's finally where we see more of a momentum that we'll see at least a rate cut, about a 70% expectation that we'll see a rate cut by September. Now, the good news is, if we get any kind of negative data, if we get a sentiment shift, rates will fall pretty quickly. That's kind of good, but it's also kind of scary because it sets you up for EPO type stuff. We will see rates in a position where they will drop when they start to drop. It could happen if we see a big momentum shift the other direction. The problem is that what we're seeing right now is very clearly entrenched. We can tell that we are absolutely not in a position to see this turn around. This is not going away. Even if we get any kind of little bit of recovery, remember, this is what we were seeing. I'm going to go to 3 months just to get a little bigger, right? This is what we were seeing before that CPI data, is that rates were better, rates got a little bit worse, rates were better, rates got a little bit worse, rates were better. We saw this ebb and flow, and then we started to go down, and we said, okay, CPI data, it should have kind of kept us right in that same range. We should have stayed above this 200-day moving average. Let's face it. I talked about this when we got the actual CPI inflation data. It wasn't that bad. I've had worse news reading the newspaper. It wasn't that bad, especially when you look at the fact that it's rounded from the hundredths. But when we got that data, one of the things that I didn't talk a lot about is when you look at the 3-month average and the 6-month average, inflation is moving up. And that's very concerning to markets. They are totally freaking out over this. And we saw a huge pivot. Then it was a question of, is that pivot going to stick around? Is this what we have to worry about? We saw a huge loss. Then we saw, just a bit of a loss and recovery on Thursday, and then recovery on Friday. And it looked like, okay, we it's not something that we have to totally freak out over. We'll get back above the 200-day moving average. And then yesterday, boom, big loss. Today, big loss. That shows that we're seeing things continue to worsen. Now, as far as what that does to actual rate sheets, I know that any rate sheet jump is bad. When you look at where we were 2 weeks ago, rates have jumped almost a half a point. We're going to call it a full half point this morning because they're already down 30 basis points. So rates have jumped a half a point in 2 weeks. That's brutal. It's brutal to see that move. I figured we'd see a quarter point and that's where it would cap out. And the fact that it's continuing has, that's changed my mind and given me that concern. And the reason that I think we are seeing that continuation, like I said before, is because what we've got going on is we've got pure pivot in how markets are dealing with the expectation of the Fed. I see some headlines talking about what's going on over in Iran and Israel and the U.S. getting dragged into this and that creating a flight to safety and on the chat right now with the argument that used to be when stocks down, bonds should improve because the money that went from stocks used to go into bonds. That happened back 25 years ago. 25 years ago. It doesn't happen today. Right? It doesn't happen. We see a sell-off in stocks. We're seeing a similar sell-off in bonds. Things are definitely worsening. And they shouldn't get too much worse, but they are getting worse. Ron said this is all about a fear of no rate hikes, which would mean the market is discounting New York Fed comments from yesterday. The fear of no cuts, you mean? It's not no hikes. It's all about a fear of no cuts. Listen, and I'm not throwing shade because I am the most guilty of all the whole of screwing up the cuts and hikes thing these days. Even yesterday on my text alert, I screwed it up once. Tim said, throw all the old knowledge out. We're in uncharted waters. Nothing makes sense. It certainly doesn't match anything we've seen before, Tim. You're absolutely right. And that's there. Tim said, what about a rate increase? And that's what the argument is. The argument is that we could see a rate increase if we see that resurgence, which is what happened back on Volcker's watch. Ron says Fed Williams expects rate cuts to begin this year. New York Fed Chief's monetary policy is in a good place. If inflation gradually eases, it'll be appropriate to cut. We'll need to start a process at this point to bring interest rates back to more normal levels. My own view is that a process will likely start this year. Yeah, that's what they keep saying. And hopefully they'll continue to keep saying that, and it'll calm markets down. I thought that would have happened by now, but we'll see Powell speak today. Markets just over panicking, overreacting. That's why I have been in that cautiously floating stance, because I want to get through this so we can see what happens next. We need to get through this overreaction. It is an overreaction, but the markets create the market conditions. You have to look at what's going on and roll with it. So anyway, that's it, my friends. As far as things go, anything closing near term, you got to consider locking, even at these terrible levels, because we do have room to see them get worse. Anything more than that, we're basically still cautiously floating. Start the day definitely cautiously floating. Let's see where things go. Reprice risk on the day is moderate. Similar to yesterday, bonds are already taking a bath, but we could see some snowball selling as the day goes on. There's really no other economic data. We got Fed Chair Jerome Powell speaking this afternoon. Rate sheets, of course, going to be quite a bit worse. Ron said, can the 10-year hold the 4.73 resistance level? If we look at technical support here, let me go ahead and pop this on the screen, give you guys that for a minute here. Ron was saying, hey, can we see this? You can see that we were at like 4.6 something over here. It's probably a Fibonacci level that you're looking at here. See, I would look at this and say, let me zoom in on this a little bit. I can't do it that way. All right, hold on. All right, so looking here, I don't think so. I think we're going to break through all that. I think we'll continue to see this creep higher. We may get a little bit of a reprieve where it comes down for a little bit, 4.68 becomes 4.63, and then it goes back up again. I think it's about the best that we're going to see on this. So we will see. So, all right, my friends. Well, again, sorry to be the bearer of bad news, but at least you're with me when we talk about it. Thanks for joining me. Remember, you can join me live tomorrow, 9:30 a.m. Eastern time. Hope you guys all have a decent day. Keep your chin up. Again, it's going to be 2024 was going to be a rough year. It's not going to necessarily get any better. Consumers are getting fed up and they've become very numb to these risks. So the good news is that they're still out there looking and finding ways to buy houses. So, all right, my friends, take care and have a great one. Bye-bye.